Greetings, Scott Nelson, Senior Wealth Manager with Boulay Financial Advisors. I'm back yet again with your second quarter 2021 market perspective. We at Boulay hope that your life is getting back to its pre-pandemic normal, or even getting better if that's possible. It's July 2021. It's been a hot one here, but we can rejoice that one uncomfortable thing that's becoming less and less of a necessity is wearing a mask. So let's go see what the economy and the markets did in the second quarter of 2021. The unemployment situation remains the biggest indicator of how U.S. is recovering from the pandemic. After a weak jobs report in April and a so-so report in May, the addition of 850,000 workers to the payroll in June was a real confidence builder. The unemployment rate in June stayed steady at 5.9%, and that's largely because the number of people re-entering the workforce to look for a job pretty much balanced off the number that actually found one. Approximately 3.1 million people have found a job in 2021, but we still remain somewhere in the neighborhood of 3.5 million jobs short of where we were in February 2020 when the unemployment rate was 3.5%. While the stock market had a couple of down weeks over the past 3 months, stock market investors have never really lost their confidence in the rebound of the U.S. economy. The broad U.S. stock market index, the Russell 3000, gained nearly 9% during the second quarter. Small stocks had been hot, but slowed just a bit in the quarter, rising just over 6%. Year to date, the Russell 3000 is up over 15%, while the S&P 500 index is up nearly 14%. Internationally, stock markets were also mostly in positive territory. The MSCI index that excludes the U.S. rose just over 5% for the quarter. European markets did better with a return over 7% as those countries began to look past the pandemic. Emerging market stocks gained a little less than 5% as many of those countries are still struggling with the pandemic and getting their populations vaccinated. The weak unemployment reports during the second quarter created some uncertainty about the recovery, which helped bonds turn in a decent quarterly return. All bond categories were in positive territory, with the Bloomberg Core Bond Index up 1.5%. The 10-year Treasury bond yield dropped from about 1.7% to 1.4% during the second quarter, which led government bonds overall to be up about 1.4%. Some bond investors thought the first quarter sell-off was overdone and snapped up corporate bonds in particular. This led that sector to gain approximately 2.9%. High-yield bonds, the loan bond category to see a gain in the first quarter, continued to perform well as bond investors kept buying higher-risk assets in order to get a better yield. The hot economic topic of the second quarter was the issue of rising prices. Overall, the Consumer Price Index, we call it the CPI, rose 5% in May, and the core CPI, which excludes energy and food, rose 3.8%. That is the most since 1992. But as you can see in the graph above, it is something that happens near at the end of many recessions, as there's a lag time between when the demand created by consumers wanting to get back to power shopping and doing the things they love occurs, and when producers of goods and services are able to meet that demand. The economic shutdown last year was of an unprecedented level and led to extensive production shutdowns and layoffs. So it was bound to lead to shortages and shipping bottlenecks that are on a level we probably have not seen since the end of World War II. With the recovery seemingly in full swing, the markets will be watching what the Federal Reserve says in the coming months very closely. The Fed reiterated in recent statements that they see no need to raise interest rates for at least a year. But market participants are also very interested in when the Federal Reserve will start reducing the amount of bonds it has been buying on an ongoing basis since the pandemic started. It's been doing that to provide stability to the bond markets and liquidity to the greater economy. As you can see, though, the Fed has purchased upwards of $4 trillion of bonds over the past 14 months to add liquidity. The recovery has now reached a point where the Fed board members have begun discussing when and how they should ease up on these purchases. The reason for the market participants' interest in this is that a tapering of Fed purchases has a similar impact as an interest rate change as liquidity growth slows down. It remains to be seen if the Fed will start tapering their purchases anytime soon and what impact that will actually have on the markets. Nonetheless, it is something that is likely to become a hot topic of discussion in the media in the coming months. Well, that is your second quarter of 2021 market perspective. As always, I hope you found it informative and it helps you to understand what is happening with the financial markets and the economy. If you have any questions, please get in touch with your Boulay financial advisor. They would love to hear from you. If you do not have a Boulay financial advisor, please reach out to us at the phone number above or email us at learnmore@boulaygroup.com. Until next quarter, best wishes for an enjoyable summer.